Think about what a house in your city cost 10 years ago. In a lot of Canadian cities, that price has roughly doubled. Now think about your salary over the same period of time. Maybe it went up by 20%. Maybe 30% if things went really well. Inflation ate most of that. This is not just bad luck, there's a structural reason. Employment income is the slowest vehicle for building wealth in Canada. It comes down to how CRA treats different types of income. The tax system does not treat all income equally, and most people never find out which side they are on until it's way too late. Quick note before we go further. This video is for education and entertainment purpose, not for financial advice. I'm sharing how the system works, not telling you what to do with it. Talk to a professional for your specific situation. In this video, I will try to explain why the system is set up this way, what business owners can do differently, and the first concrete step you can take to change your position. All the reasons why I left my six-figure job to start a business. Let me walk you through what the employee experience actually looks like from a cash flow perspective. You earn $100,000. Before you ever see a dollar, CRA already taken its share automatically. The sequence is tax first, spend second, and then invest the last with whatever survives. Meanwhile, the real assets are not waiting for you. A house in Toronto, a growing business, an equity stake in something, this compound whether you are participating or not. Here's the analogy that clicked for me. Being an employee trying to build wealth is like trying to fill a bathtub with the drain open. The drain is tax. It is automatic, it's immediate, and non-negotiable. No matter how hard you work on the tap, you're always fighting the drain. Business owners do not have that drain running from the start. They got to plug it first. Here's the core mechanic. CRA taxes employee on gross income. CRA taxes business owners on net income as revenue minus expenses. The same $150K earned, completely different tax bill. Let me walk through the numbers. Employee earning $150K in Ontario, tax on the full $150K with the $50K in real expenses like phone, car, and fuel. Those expenses give zero tax relief. The total tax bill approximately $40,800. Now sole proprietor earning $150K with the same $50K in legitimate business expenses, taxable income drops to $100K. The tax bill approximately $20,700. That is $20,100 saved for the same income and the same spending. The other option is incorporated. Incorporated small business with the same $100K net eligible for the small business deduction. Corporate rate as low as 12.2% in Ontario on the first $500K net income. Tax bill approximately $12,200. Note that this is for the corporation and not your personal income. The structure on how you earn changed everything, not the amount. By the way, if you're running a business and spending on things like fuel, software, business travel, or supplies, the right credit card stacks rewards on top of those deductions. I use Finley Wealth to compare business cards and find the best fit for my spending. Link is in the description below. The expense deductions is only one side of this. The second advantage is about timing, and it is just as important. Employees pay tax before they ever touch their money. The moment your paycheck lands, CRA already collected. What you see is what you get. Business owners work the other way. When a client pays you $1,000, you keep the full $1,000. You can invest it, you can buy equipment, you can put it in high interest account or GIC. The tax on that money not due until you file tax next year. Think of it this way. The government is essentially giving business owners an interest-free loan. The full pre-tax amount for up to a year. Employees never get that loan. The money is gone before they even see it. And there is another layer of control. Business owners can time things strategically. You can push product launch to January, pull forward, and equipment purchase to December to reduce the tax bill. Employees have no leverage like that. Now I want to zoom out for a second because this is not just tax conversation anymore. AI is already replacing entry-level and mid-level roles. Data entry, organizing, drafting, customer support, scheduling. Jobs that felt stable a few years ago are being automated faster than most people expected. The employees who rely entirely on a single paycheck is increasingly exposed. A business structure is not just a tax move, it is a hedge. You own the output, the clients, the product, the equity, not just the hours. When AI eliminates a role, the employee loses the income. When AI helps a business, the owner captures the gain and gets more profit. Your labor is getting cheaper while the assets and the equities are getting more expensive. Quick question, what is one task in your current job that you think AI could already do? Drop in the comments below. I'm genuinely curious. And here's what the flip side that most people miss. The same technology that eliminating jobs it's collapsing the cost of running business. AI can handle bookkeeping, invoicing, contracts, client communication, and making presentation. The barrier to start a business has never been lower. If you're finding this is useful, please hit like and subscribe. More videos in this series are coming. What I'm saying is you do not need to quit your job tomorrow. That will be reckless, especially without emergency funds. Try to start a side business while you're still employed. It doesn't have to be big ideas. It just have to be a skill that provides value to people and solve their problem, like consulting, freelancing, a service, or even a product. The work that you are doing right now at your job could be the exact foundation. You can start with a very low-cost business that has low risk. Step 1. Register as sole proprietorship. Simple, low cost, minimal paperwork. Your business expenses start reducing your taxable income immediately. Step 2. Track everything. Every legitimate business expenses. Your phone, your software, travel, home office, those are counts as deduction if you genuinely tied to earning income. Step 3. When your income grows and the math makes sense, look at incorporating. Lower corporate tax rates, liability protection, income splitting options, but only when the structure earns its costs. Incorporation and annual filings are not free, so it is not always the right first move. The goal is not to have a business for the sake of it. The goal is to move to the other side of system. This takes time. Most businesses are not profitable in year 1, and that is actually fine. A net loss in your side business can offset employment income, which can mean a tax refund even when the business is not making any money. But do not fake it. CRA requires reasonable expectation of profit. A hobby is not a business. If you're claiming expenses, you need to be genuinely trying to earn income, not just writing things off. And manage your expectation on lifestyle too. A side business means evenings and weekends and trade-offs. The payoff is not immediately, could take a few years, but the compounding in equity, in tax saving, and in options starts the moment you register. Let me summarize the differences. The house price that doubled, the salary that didn't. The system is not neutral. Employees pay tax first, spend second, invest less, with no deductions, no timing control, no equity. Business owners deduct first, invest with pre-tax dollars, and build something they own. CRA did not design this to be unfair. It is designed to reward people who take on risks and create economic activity. The question is which side of that design you want to be on. Now, if you are looking for the best corporate credit card in 2026, you can check this video. And if you are ready to start treating your spending like a business, check out Finley Wealth in the description below. Find the right business card for your situation. I may receive a small commission if you're using my link below, and you will get a cashback reward or points according to the credit card program that you select. Thank you for watching, and I will see you in the next video. Bye.